Hello, and welcome to today's training session on greenhouse gas accounting. My name is Oliver Blaker, and I'm a Net Zero Principal Consultant at Ricardo, and I'm joined by my colleague Ben Boxer, who is a specialist in Scope 3 emissions and sustainability strategy. Today's session is part of DAERA's support program for public bodies, helping you meet your climate change reporting obligations under new regulations. Thank you for taking part and reviewing today's webinar. Today's training is split into 5 sessions, starting off with an introduction to carbon accounting, then looking at how you can understand your organization in the context of the Greenhouse Gas Protocol. Then we'll have a session on Scopes 1 and 2, and then a session on Scope 3, and then finally we'll have a session on wrapping up all of the learnings from the previous sessions into an emissions data management process, which can help you create a robust reporting structure for your carbon emissions. Let's begin with session 1, which is all about laying the foundations. We'll start by looking at what climate change is, why it matters, an introduction to carbon accounting and how we use the Greenhouse Gas Protocol as the global standard for carbon accounting. We'll then look at emissions factors and how we can use those to calculate the carbon emissions of certain activities. And then we have a small presentation from the DFE on their energy and carbon data repository.
So, what do we mean by sustainability? A classic definition comes from the 1987 Brundtland Commission, meeting the needs of the present without compromising the ability for future generations to meet their own needs. In 2015, the United Nations launched the Sustainable Development Goals, a shared blueprint for sustainable development, all of which to be achieved by 2030. The 17 goals cover a broad range of environmental and social topics. Corporate sustainability is typically broken out into 3 pillars. Environmental, covering topics such as climate change, pollution, biodiversity, water consumption. Social, which focuses on equity, diversity, and inclusivity, human rights, as well as any other issues associated with communities and people in general. The final one is governance, which includes corporate governance, financial stability, and the responsible management of organizations.
The topic relating to sustainability, which we're going to be discussing today, is climate change. Climate change is the altering of natural climate patterns and weather systems as a result of the release of greenhouse gases into the atmosphere. The image on the right is called the climate stripes, created by Professor Ed Hawkins. Each stripe represents a year, showing how global temperatures have changed over time, with blue stripes indicating cooler years and red stripes indicating warmer years. In 2023, the pattern had been updated to a new, darker red because of temperatures rising faster than ever. This visual is a powerful reminder of why climate action is urgent. It is also why sustainability and emissions mitigation are becoming increasingly important for all organizations, especially in the public sector. So what do we mean by emissions? Emissions are generally categorized into 2 types: air pollutants and greenhouse gases. Air pollutants include substances like sulfur dioxide, volatile organic compounds, carbon monoxide, and particulate matter. These are harmful to human health and the environment, but they do not cause climate change. Greenhouse gases, on the other hand, or GHGs, we are most concerned with in this training. These include carbon dioxide, methane, nitrous oxide, and fluorinated gases. These gases trap heat in the atmosphere, contributing to global warming and climate change. So how exactly do greenhouse gases cause climate change? It all comes down to the greenhouse effect. GHGs in the atmosphere act like a blanket, trapping heat that would otherwise escape into space. This natural process keeps our planet warm enough to live on, but human activities have intensified it by releasing excessive amounts of greenhouse gases into the atmosphere. This is why managing and reducing emissions is so critical. It's not about compliance, it's about protecting our climate and our planet. For your organization, there are several compelling reasons to manage your organization's greenhouse gas emissions. Firstly, it helps you prepare and comply with government regulations, including the regulations from DAERA. It also reduces your exposure to climate-related risks like extreme weather and can lead to operational improvements and cost savings. From a strategic perspective, it enhances your reputation with investors, customers, and employees, and increasingly, stakeholders expect transparency and action on climate change. So greenhouse gas matters management is not just a technical exercise, it is a strategic opportunity for your organization. Let's take a look now at the targets set out to reduce greenhouse gas emissions. In 2022, Northern Ireland set the Climate Change Act, which required a 48% reduction of emissions by 2030 and a 100% reduction in emissions by 2050, compared to the 1990 carbon emissions output. There's also a requirement of 80% of electricity to be sourced from renewable energy sources and 70% of waste to be recycled. Similarly, the European Union has targets set to reduce emissions by 55% by 2030 and at least 90% by 2040. The UK has emissions reductions from 68% by 2030 and to reach net zero by 2050. Net zero being typically a reduction of 90% of decarbonisation and then a further offsetting of 10% to mean that there is a balance between our remaining carbon emissions output and removals technologies to abate the rest of the UK's emissions. The Northern Ireland reporting requirement set out by DAERA involves two parts. The first part, which we'll be focusing mostly on today, is mitigation reporting. This is a 3-yearly cycle which requires your organisation to set a greenhouse gas baseline from April 24 to March 25. This includes the emissions from scopes 1 and 2 and optionally scope 3. You also then need to set out your policies and proposals for reducing emissions along a time frame, along with a review of any steps that have been taken. Then there is adaptation reporting. So 4 years after the first report, you will have to publish your first adaptation report, which involves you looking at what the impacts of climate change will be on your organization, as well as further reporting on the actions you're taking to mitigate your organization's carbon emissions. Now, let's have an introduction to carbon accounting. What is greenhouse gas accounting? Simply put, it is the process of quantifying your organization's greenhouse gas emissions. It follows internationally recognized standards like the Greenhouse Gas Protocol to help you track progress and set a reduction target and monitor your progress towards that target when repeated over a number of years. It also enables participation in emissions trading schemes and climate programs such as the Science Based Targets Initiative or the Carbon Disclosure Project, otherwise known as CDP. It is also the foundation of a credible climate strategy. The idea with carbon accounting is that you accumulate all the emissions across activities within a certain boundary to create a carbon inventory. Carbon inventories can be made up at the company level, the project level, or in the case that's on screen, at the country level. So Northern Ireland maintains a greenhouse gas inventory which tracks emissions across all sectors, including energy, agriculture, transport, and industry. And the carbon accounting which you're going to be carrying out as part of your public body reporting will feed into this broader picture to ensure that Northern Ireland is meeting its climate goals. Corporate carbon accounting typically follows the Greenhouse Gas Protocol. The Greenhouse Gas Protocol is an internationally recognized standard for corporate carbon accounting by all organizations following a similar standard on how they collate and include various activities and emission factors into a corporate carbon inventory, allows for comparability and robust reporting on emissions. The Greenhouse Gas Protocol is originally designed for businesses, but it is also widely used for public sector organizations with some small adaptations, which we'll be covering today. It is key to align your reporting with your operational and reporting structures and have it and manage it with the Greenhouse Gas Protocol. A key component of the Greenhouse Gas Protocol is this idea of scopes. Greenhouse Gas Protocol sets out emissions into 3 different scopes: Scopes 1, Scopes 2, and Scope 3. Now, we'll be referring back to this diagram periodically through today's training, but to give you a brief introduction, Scopes 1 includes emissions that come directly from the reporting company. I like to think of this as you being able to see the source of the emissions. It is happening on site. That would include a company vehicle or a gas boiler inside one of your facilities where that fossil fuel or that carbon emission is being produced on site. Scope 2 is associated with purchased electricity, steam, heating, or cooling, which is being used by the reporting company. So this is a set amount of energy that is being created, but the emissions associated with that energy production are being produced off-site, but that electricity is being consumed directly by that organization. Scope 3 is emissions associated with the broader value chain. So these involves emissions upstream and downstream. So this includes emissions from purchased goods and services, so what you purchase in order to carry out your operations. It involves capital, so machinery or other equipment that is used to carry out your operations, and that involves the emissions associated with the manufacturing of those goods and those services and that capital. Also, upstream emissions include sources such as waste, business travel, employee commuting, or energy from other leased assets. Downstream, you have emission sources that include transportation, so that's transportation of goods from your operations to the customer. The processing of sold products, if your product needs further processing to be turned into the ultimate product. Use of sold product, if you're an organization that produces energy consuming products that consume energy during their life cycle. End of life, so if your organization produces physical goods, you need to consider the ultimate waste disposal of that good that you have produced. Then leased assets, franchises, and investments also have emissions associated with them that need to be considered within Scope 3 of your organizational carbon inventory. The Greenhouse Gas Protocol is built on 5 core principles that ensure your emissions reporting is robust and credible. Firstly, relevance. Your data should reflect the emissions that matter most to your organization and stakeholders. Secondly, completeness. You need to include all relevant emission sources and activities across your value chain. Consistency. Using the same methodology year to year allows for comparison and for you to understand what is changing in your organization. Ensuring that you document your methodology and allow it to be repeated is important. Fourth, transparency. Be clear about your assumptions, your methods, and your data sources. Finally, accuracy. There are different levels of accuracy that come with carbon accounting. Your first inventory might not be particularly accurate, but over time, you should continue to strive for a more accurate carbon inventory and document and be transparent about the changes that you're making to your inventory to improve the accuracy.
Calculating emissions is a rather simple equation. It is the multiplication of an emissions factor and an activity. An emissions factor is a coefficient for the amount of carbon dioxide that is produced from a certain activity. An example of that would be the grams of carbon that is produced from a kilometer of driving. That would be an emissions factor. So, to calculate the emissions from an activity, you would multiply the emissions factor by the activity. So, for example, if you burn 1,000 liters of diesel, and the emissions factor for diesel is 2.66, you would multiply the two together to calculate the amount of CO2 that is produced.
Here on screen are a few tips associated with emissions factors, and we'll be covering these in more detail as we go through today's sessions. But starting with the first, units. It is important that the emissions factor you're choosing always matches the unit of the activity and vice versa. So for example, you'd like to know the emissions associated with a certain number of liters of petrol. That means you would need to have an emissions factor per litre of petrol. So this may require some conversion to manipulate the activity to a certain unit. Secondly is source. Sources of emissions factors is important, and you do need to make sure they come from a reputable source. For example, the UK DAERA has a set of emissions factors which are published every year, and that includes a broad range of emission sources from transportation, public transportation, waste, as well as many others. Location. Emissions factors are specific to a certain location, and so when picking an emissions factor, it is important that you pick a location associated with that emissions factor that is relevant to the emissions where the emissions activity occurs. For example, in the US, you would use factors associated with the EPA. Those are not the same as the UK DEFRA factors, and you should always seek to choose the most relevant. Next is time. So emission factors change over time, and so every year you should look to update your factors where there are new factors available. A good example of this is the energy grid. So every year the governments around the world publish the grid factor, so the emissions produced per kilowatt hour of electricity consumed in a certain country. And as grids decarbonize, this number will reduce. And so it is important that you use that latest figure in your emissions reporting. Now, let's take a look at carbon dioxide equivalence. CO2 equivalence expresses the climate change impact of all greenhouse gases in the terms of CO2. On the left, you'll see a number of different emissions producing activities, and you'll note that they produce multiple greenhouse gases. Now, different greenhouse gases have a different amount of global warming potential. An example would be methane. Methane has 25 times the global warming potential of carbon dioxide. So, when calculating a CO2 equivalent factor, you take the CO2 that is being produced and multiply that by 1. You then add to that value the methane that is being produced and multiply that by 25. You do this for all greenhouse gases that are being produced by an emissions producing activity, and you then report your CO2e equivalent factor. This is particularly important for greenhouse gases such as HFCs and PFCs, because as you'll see in that table on the right, they have a significant global warming potential. These gases are typically found in fire extinguishing systems or air conditioning units. And looking there, you'll see that a small amount of those gases will have a disproportionate effect on your greenhouse gases, considering the potency. So a single kilogram of HFCs is 14.8 tons of CO2. So it is important to pay attention to the emissions factors that you're using and making sure that you are reporting all greenhouse gases in the form of CO2 equivalents. This is the end of the first session of the DAERA Greenhouse Gas Carbon Accounting Training. Welcome to the second session of the DAERA Greenhouse Gas Accounting Training. The second session will focus on understanding your organization through the lens of the Greenhouse Gas Protocol. This session will focus on understanding your organization and your value chain. We'll look at the various boundary setting methods underpinned by the Greenhouse Gas Protocol. We'll look at how you can identify the greenhouse gas emission sources across your organization, organizing your inventory, and how you can set your emissions baseline. Firstly, when starting your carbon inventory, it is important that you map out your organization. Take a look at your financial accounting structures or your organizational structure and determine what is the best way for your organization to structure your inventory. Take this example on the right of Ricardo. You have our energy and environment business, you have our rail business, our performance products business, and our automobiles and industrial business. For us, this makes sense because each of the different business units has a different a value chain and different operations. So we need to look at those in those different ways and look at the different emissions producing activities underneath them. So yes, secondly, identify the emissions associated with each of the activities at every facility or operation that you carry out. So for example, at our London office, it's a simple office. We only have electricity and refrigerants there. In our Shoreham office, we have electricity, we have refrigerants. We also have things such as testings, fuels, and a fleet of company vehicles. So set out your organization and review your organization's emissions producing activities, identifying all the gaps and data points that you need to calculate your emissions inventory. You need to set a period as well. Typically this is 1 year and it is aligned with your financial reporting, but also you need to consider the DAERA reporting requirements of April 24 to March of 25. Once you've mapped out your organization, you need to look at the different levels of control that you have across your organization and pick from one of the 3 boundary setting methods under the Greenhouse Gas Protocol. The first method that's available to you is that you select is operational control. This is where you include all facilities and all emissions producing activities for where you have operational control, where you have the ability to influence the running of that operation. Secondly is financial control. This is where you typically don't have control over the specifics of the operation, but you do have control over the finances. You could employ an operator to manage a facility, and you manage that contract, which would be an example of financial control. Then finally, equity share. This is where you include the emissions from all facilities, entities, or organizations of which you have an ownership share. You include all of the emissions that are being produced, and you then multiply the emissions by your ownership share in a particular entity. So for example, if looking on the right, you can see there's automobiles and industrial. Say that is a joint venture with another organization. You would take all of the emissions associated with that entity and multiply it by the percentage ownership that your organization has in it. When looking at these boundary setting methods set out what should be included in your scopes 1 and 2, and then what lays typically outside your boundary setting method is your scope 3. So once you've understood your organization, you then need to look at your value chain. Now, every organization's value chain is different based on the goods and services which you produce and provide. So just as an example, we'll look at the value chain of a laptop and an organization which makes and distributes laptops. So the value chain of a laptop starts with its raw materials. So there are emissions associated with the extraction and production of those raw materials. Then there are emissions associated with the manufacturing and assembly, as well as transportation emissions across each of those steps as goods move from place to place. So you need to be accounting for the emissions of those processes in your scope 3. Then on the downstream, you have the use, the disposal and processing of that laptop at the end of its life. So you need to consider this sort of concept for all the goods and services which you produce, and consider all of the emissions producing activities associated with the upstream and downstream emissions of your organization. So, as we previously mentioned, there are 3 different scopes of emissions under the Greenhouse Gas Protocol. So once you've understood your organization and you've listed out all of the emissions producing activities across your different entities, you then need to organize them by scopes. So as I've mentioned, scope 1 is your direct emissions, which come from your factories or emissions associated with gas consumption or fugitive emissions. Scope 2 is your indirect emissions associated with energy consumption, where the energy is produced off-site. And then scope 3, which includes all of the emissions associated with your upstream and downstream operations. So, the topic of double counting is an interesting one within greenhouse gas accounting. The idea is that the scopes scopes 1, 2, and 3, allow for companies to account for emissions across their value chain without double counting, because scopes 1 and 2 are emissions directly associated with activities carried out by the organization. Scope 3 are emissions that are produced by another organization on behalf or related to the reporting organization. So the idea is that if every single organization accounted for their scopes 1 and 2, that would account to the total scope 3 of every other organization. Double counting does occur within scopes, and this is an area which does need to be considered, because as you use different methodologies to calculate your emissions, it is important to ensure that you are not accounting for activities twice. For example, if you are using mileage values for your vehicles, but then at the same time you are using liters of fuel for other vehicles, and there was an overlap in that. That is the type of double counting which should be avoided. But it's important to stress that double counting across the scopes across different organizations is perfectly normal within corporate carbon accounting and encouraged.
Setting a baseline. Your baseline year is the first year of carbon accounting for which your organization's progress is tracked against. You want to choose your baseline year to be the earliest year where you have a full set of data. So you want to have a complete set so that any future year can be consistently monitored against that first year. You may wish to choose to align your baseline year with your organization's financial year or calendar year, but it's worth remembering that the DAERA reporting period is from April to March 24 to March 25. So if you haven't done a carbon inventory yet, it may be worth considering aligning to that reporting period.
So, as mentioned, the Greenhouse Gas Protocol is a protocol specifically designed for large corporate organizations. But in the DAERA reporting requirements, there are a number of local councils, which are public bodies, which can use the Greenhouse Gas Protocol, but there are some slight variations there which do need to be considered. So the difference comes from a large corporation which has a specific boundary. It's very obvious to know what an organization in a large corporation owns and doesn't own. Whereas with the local council, they typically have a broader remit and a different structure that means that there is some ambiguity on what emission sources are to be included or not included in your emissions inventory. So an example of this is constituent waste. So local councils have a responsibility to process waste associated with constituents, but the council doesn't control or have operational control over their constituents in such a way, and so can't really influence the waste and is providing a public service. So this may not be an emission source which is considered within Scope 3, but you still should aim to calculate it and report it, because of course it is a service that the council provides. So, when going through your carbon inventory, review the Greenhouse Gas Protocol for the specifics of what you should and shouldn't include in your carbon inventory, and then consider the boundary setting criteria that you've set as to whether you have operational control over certain emissions sources.
Within this next session, we'll be looking at scopes 1 and 2 in more detail. Within this session, we'll be identifying the key emission sources within scopes 1 and 2, required data and emissions factors and where these things can be sourced, and the considerations that need to be prioritized to ensure quality and high quality and accurate reporting. A discussion around location versus market-based reporting in scopes 2, and then some example calculations and an example scopes 1 and 2 inventory. So firstly, a summary of the key emission sources within scopes 1 and 2. Scope 1 can be broken down into 4 distinct categories of emission sources. Firstly, the combustion of solid, liquid, or gaseous fuel in non-mobile or stationary equipment, including things like boilers, furnaces, and generators. Mobile combustion, on the other hand, includes owned or leased mobile sources, so that's both on-road and non-road vehicles that sit within the company's inventory boundaries. Other vehicle emissions may sit within your Scope 3, which we'll cover in the following session. Fugitive emissions typically result from refrigeration and air conditioning systems which emit greenhouse gases due to leakage and service over the operational life of the equipment. The leakage of refrigerant gas, for example, is typically quite a small quantity, but can be a significant source of emissions because of the high global warming potential or emissions factors associated with these substances. And then finally, other organization-specific emissions arising from processes such as certain manufacturing operations or the release of medical gases during certain procedures, for example. So these will be highly dependent on the activities within your organization. Emissions from all of these Scope 1 sources are defined as direct emissions, as they occur from sources owned and controlled by the reporting organization. Scope 2 emissions, on the other hand, are considered an indirect emission source because they are a consequence of activities of the reporting organization, but the actual emissions generating activities occur at sources owned and controlled by an outside entity. Scope 3 is also concerned with so-called indirect emissions, but Scope 2 is where indirect emissions that are caused during the generation of energy that's purchased by the reporting organization is accounted for. Your organization is responsible for the procurement of this energy and how much energy is utilized, but the emissions of greenhouse gases occur elsewhere and is directly controlled by another organization, such as an electricity utility provider. Purchased energy includes electricity, but also steam, cooling, and heat. For example, if your organization purchases heat from a district heating network. As electricity usage is included in Scope 2, it's typical that an organization's Scope 2 emissions might actually increase as it takes effort to decarbonize its operations because of electrification of vehicles and heating systems, for example, which serve to reduce Scope 1 emissions. This is why the procurement of renewable electricity alongside efficiency measures to reduce overall energy consumption is a key priority for many organizations looking to decarbonize, and we'll touch on that later in the comparison between location-based and market-based reporting. So now that you've identified applicable emission sources within Scopes 1 and 2, we'll move on to the required data and emissions factors that are needed to actually calculate these emissions. The activity data for Scope 1 emissions from stationary and mobile sources look largely the same, comprised of fuel consumption figures broken down by fuel type, for example natural gas usage in a heating system measured in kilowatt hours or the litres of petrol used in company cars within the annual reporting period. To calculate fugitive emissions, the quantity of refrigerant added to on-site systems is needed, again broken down by the type of refrigerant used in the system, such as HFC 134A or R401B, as the amount of greenhouse gases released from each of these substances when it escapes the atmosphere is different and unique to that refrigerant. Note that this volume or mass of refrigerant is only that which is lost to atmosphere during the reporting period. This is commonly identified as the top-up value in a system maintenance record, for example, as the refrigerant which has escaped due to system leaks is replaced periodically. A common mistake is using the total quantity of refrigerant in the system, referred to as the system charge. If the top-up quantity is not available, leakage can be estimated from this system charge by using an annual leakage rate estimate from a reliable source. Scope 2 data is fairly straightforward. Typically, it looks like the kilowatt hours consumed by the organization, ideally broken down by meter location or organizational structure. Scope 1 and 2 data is sourced from invoices, utility bills, on-site meters which feed into energy management systems, or estimated from purchase receipts. As such, collaborating with teams across the organization is a good place to start to collect the relevant data and start to engage individuals across the organization who are responsible for managing Scope 1 and 2 sources, such as those that sit within operations, fleet, and facility teams. There's some key considerations when collecting this data, and they're listed in this green box at the bottom, and they include things like the breakdown of where in the organization these emission sources are located, such as site or asset ownership or control. Again, that's dependent on the organizational boundary set at the start of the inventory process. The time period of data, which should align to the overall reporting period for the GHG inventory. and that's used to assess completeness and avoid double counting, which we'll touch on in another slide. And then the units of measure is a really key thing to bear in mind and to ensure is recorded alongside all of this activity data, as that will determine which emissions factors are selected to ensure the calculations are performed correctly. Emissions factors obviously represent the quantity of CO2e or CO2 equivalent per kilowatt hour, litre, meter cubed, or whatever that unit of measure of fuel consumed or leaked refrigerant, for example, in scopes 1, scopes 1 and 2 is. And the key thing here is that the emissions factors selected must be expressed in the same units of measure as the activity data which is being collected for each emission source. So if not, the activity data must be converted to the same units of measure as the emissions factor or vice versa, and this can be done using secondary conversion factors which are specific to each of the different fuel types. Emissions factors vary based on geography and time period, and this variance can be significant, so it's best practice to align as closely as possible to your data that you have collected and source emissions factors from reliable and reputable sources. And the recommended source for most UK-based reporting is the annual emissions factor database published by DESNES, part of the UK government. And this database is actually embedded into the DAERA submission portal. For most Scope 1 fuels, emissions factors are listed in a variety of measurement units. So again, we must select the factor which is in the same unit of measure as the activity data where possible. Scope 2 emission factors represent the quantity of CO2e per unit of energy consumed from the grid. This is usually expressed in kilowatt hours. For electricity, Scope 2 emissions factors typically represent the electricity mix of the grid in which consumption occurs and during the time period in which that consumption occurs. And it takes into account various different production methods that feed into the electricity grid using from the burning of coal, natural gas, or from renewable generation methods, for example. And these can obviously vary significantly, both with geography and time period, as regions and national grids aim to decarbonise over time. For example, for Northern Ireland, the emissions factor for the national grid has reduced by over 45% between 2004 and 2020, which demonstrates the importance of selecting the correct year and location of emissions factors when it comes to Scope 2 accounting in particular, as this variance can be usually more significant than for Scope 1. This figure from the IEA shows the relative contributions of electricity generation methods to the UK electricity grid over the past 20 years or so. As the relative contribution of emissions intensive generation methods such as coal and gas have reduced and been supplemented by an increased supply of power from renewables like wind, solar and biofuel, the average national electricity emissions factor has reduced. Up until now, we've been focusing on what is called location-based Scope 2 reporting, which is the mandatory method of accounting for Scope 2 emissions under DAERA. Location-based methods reflect the average emissions intensities of grids in which consumption occurs. It does not, however, consider efforts made by organisations to purchase renewable energy, for example. So-called market-based reporting, on the other hand, does, as it accounts for emissions intensities of specific energy contracts procured by reporting organisations. For example, renewable energy purchase backed by REGOs. Market-based reporting is currently optional under DAERA reporting regulations. Other supplier-specific emissions factors can be used to generate market-based numbers if available, or if not, residual mix factors can be sourced at the national level. These reflect the energy sources that remain after all supplier-specific emissions intensity claims related to specific energy generation attributes have been accounted for in the overall grid makeup. Of course, some organisations may be taking efforts to reduce or supplement their reliance on the grid by installing on-site renewables such as wind and solar. The generation of on-site renewables isn't an emission producing activity, although there will be other indirect emissions from the manufacture and installation of this equipment, for example, which will be captured in organisation Scope 3. Scope 2 emissions are only based on your net consumption from the grid, so on-site renewables will reduce location-based and market-based totals, especially if you are exporting excess electricity back to the grid. Now that activity data and emissions factors have been sourced for all relevant emission sources in Scopes 1 and 2, emissions can be calculated. As a reminder, the general method for calculating emissions is a multiplication between activity data and emissions factor, and emissions are generally reported in tons of CO2e. This Scope 1 example includes estimates of emissions from 3 key sources. The sources are labelled, measurement units are clearly displayed alongside the activity data presented, and these units align with the emissions factors source from a reliable source, in this case the DESNES database for the correct reporting period. It's always a good idea to include a traceable trail of data sources and any kind of intrinsic assumptions you use to generate these results. This is valuable for any third-party auditing that your organization might undertake of your greenhouse gas inventory, but also for making next year's reporting easier, especially if teams or individuals conducting the greenhouse gas inventory change internally. This may look like including links to saved invoice files to evidence consumption figures, for example. Note that the generator fuel source in this case is financial spend data. The fuel consumption has been estimated from spend, which is typically done in the absence of primary data, and we'll expand on that in more detail in the coming sections. Note also the high global warming potential or emissions factor of the refrigerant, in this case R401B, which I mentioned before. Obviously, despite leakage quantity being relatively small, this high emissions factor can mean that emissions are significant from fugitive emission sources. Finally, emission sources are typically presented in tons of CO2e, so there's an additional division by 1,000 that's not shown here, so keep an eye on that and ensure the correct units of measure are used, although emissions can obviously be presented in kilograms CO2e if the quantities are more appropriate. And then finally, it's always good general data handling best practice to display all figures to consistent decimal places. This Scope 2 example similarly shows this multiplication between activity data in kilowatt hours of consumed electricity and the relevant emissions factors for both location-based and market-based reporting. As a reminder, this top figure of 10.35 tonnes in this case would be the mandatory Scope 2 figure in the DAERA submission, but market-based emissions can also be submitted optionally. In this case, REGOs are available for 100% of electricity for this organisation, meaning they procure 100% of their electricity from REGO-backed tariffs, so market-based emissions in this case are reduced to zero. Note there are some nuances and details around calculating emissions from electric vehicle charging on site if that applies to your organisation, and there's more guidance in the DESNES emissions factor database on how to correctly account for this using their factors. Whilst the goal of greenhouse gas reporting is full coverage of all facilities and all sites for the full list of emission sources for the full reporting period, using primary activity data backed up by evidence in the form of invoices, for example, this is often not entirely feasible, particularly if this is your first time accounting. If there is gaps in data, there are a few different methods you can use to fill in those gaps, such as prorating or extrapolating based on the data you do have available. Or if you're missing data for emission sources entirely, you can look to previous reporting periods and use historical data or data from similar locations or sites within your organization as kind of proxy estimates for emissions, or even secondary benchmark values for energy consumption based on floor area can be used, and a good source of those values is published by the Chartered Institute of Building Services Engineers, or CIBSE. These obviously have kind of inherently more inaccuracy in using these secondary sources, but they're still a valuable method of estimating emissions, particularly if this is your first time conducting a greenhouse inventory. And we refer to this usage of basic calculation methods as emission screening. And yeah, it generates a sort of rough order of magnitude scale of emissions per source to determine if those emission sources merit the use of a more advanced and accurate emissions calculation method, which is obviously might be more time consuming or data intensive. And it's worth noting that there's a degree of kind of inherent inaccuracy in emissions factors across the board, dependent on the emissions factor sources. And any sort of modeling estimations used to estimate fuel usage, even with the kind of higher quality calculation methods. And it's worth bearing in mind that 100% accurate quantification of emissions is not the ultimate goal and priority per se. So sort of acknowledgement of imperfections in estimating emissions is always worth to bear in mind anyway. And obviously, ultimately, effort should be placed on bringing down the numbers and not focusing entirely on 100% accuracy across the board. And improvements to accuracy will likely be iterative with each reporting cycle, and efforts to improve accuracy should be focused and prioritized in areas of significant emissions, which we refer to as hotspots. The final point around making a note of all assumptions and referencing all sources is key and refers back to the 5 reporting principles, principally the principle of transparency. Whilst the goal is always full coverage of all facilities, all sites, all emission sources, covering the full reporting period, using primary activity data backed up by evidence in the form of invoices, DAERA recognises this is often not entirely feasible, particularly if this is your first time accounting. If there is gaps in your data or missing data sources, there are a few different methods you can use to fill in those gaps, such as prorating or extrapolating what data is available, or looking to previous reporting periods or years to use historical data or data from similar sites as proxy sources within your organization, or even looking externally to secondary industry or kind of sector-specific benchmark values, such as energy consumption benchmarks published by the Chartered Institute of Building and Services Engineers, or CIBSE. Obviously, there's inherently kind of more inaccuracy built into using these secondary sources, but that's okay, particularly if you're screening emissions for the first time. And screening is this use of basic calculation methods to determine the sort of rough scale of emissions per source, and that gives you an idea if those emissions merit the use of kind of more investment in time and resource into improving the accuracy of emissions calculations, and those efforts should be focused on areas of high emissions. And it's worth bearing in mind that 100% accurate accounting of emissions isn't the goal here. It's to get a feel for where the emissions hotspots are located within your organization's activities and focusing efforts in those areas. And improvements will kind of naturally occur with each reporting cycle in an iterative approach. So yeah, these methods of supplementing primary data are valuable just to give full coverage of your organization's activities. Where assumptions and secondary sources are used, it's key to keep a note for sort of audit trail and to help reporting next time around, as I mentioned before, referring back to the 5 principles of reporting as recommended by DAERA, namely the principle of transparency. And the submission portal provides opportunities for organizations to be transparent about these sources and kind of areas of uncertainty. It's just a straightforward example of prorating energy consumption based on the 10 months of data which is available for this example organization. So dividing the total annual consumption for those 10 months by the total number of days covered by data to give an average daily consumption of just under 240 kilowatt hours per day in this example, which can then be multiplied by the days of April and May where primary data is not available. And then that total can be added to the 72,700 kilowatt hours where primary data is available before that total estimated annual consumption value of 87,000 kilowatt hours can be multiplied by an appropriate emissions factor to estimate emissions. Similarly, here is an example of one of those CIBSE energy benchmark values, and they provide energy usage estimates per meter squared of floor space for different building types, which, as I said before, can be used to estimate energy consumption where there's no primary data available. Finally, once emissions have been estimated from each of the Scope 1 and 2 emission sources, they can be collated into a Scope 1 and 2 inventory. In this example inventory here, we have 2 sites and a number of typical Scope 1 and 2 sources, with Scope 2 reporting using both location-based and market-based methods. Activity data and emissions factor sources are presented alongside the numbers themselves. Units of measures are aligned between the 2 parameters, and data is broken down by site at which consumption occurs. In the Scope 2 market-based reporting, a combination of REGOs and residual mix factors have been used based on the supply and data availability, and the hotspot emission sources can be identified in the final column where proportional contribution of emissions to the totals are displayed in percentages. So in this example, natural gas usage in both sites would be identified as priority areas for data improvements and decarbonisation efforts, such as firming up any assumptions in the emissions calculations and looking to implement electrification or efficiency measures, for example. Next up, we'll be taking a look at Scope 3 greenhouse gas accounting. Within this section, we'll be looking at the 15 Scope 3 categories as defined by the GHG protocol, a discussion around relevance and materiality when looking at each of those categories, and running through some example calculations before highlighting the key challenges and opportunities in Scope 3 reporting. As highlighted elsewhere in the training, there are up to 15 distinct categories of emission sources that are accounted for within Scope 3. Defined by the GHG protocol, these include activities such as embodied emissions that occur in the manufacture and transportation of purchased goods, waste generated by organisations, and emissions from employee commuting, which are all examples of upstream Scope 3 emissions. Downstream emission producing activities, on the other hand, include things like emissions from leased assets and investments. As with Scope 2, all of these Scope 3 categories are defined as indirect emission sources because they are a consequence of activities of your organisation but occur at sources owned and controlled by an outside entity. So there's less direct control and visibility of where emissions are actually produced in the value chain, but you as the reporting organisation still have the ability and responsibility to monitor and influence these activities. DAERA stipulates that Scope 1 and 2 reporting is mandatory, whilst all of these Scope 3 categories is currently optional. Although we'd recommend that organisations begin to consider their Scope 3 impact where possible, as it represents a more holistic view of the true impact of your activities as an organisation. Scope 3 reporting helps organisations understand their broader climate impact beyond the walls of their on-the-ground facilities. These emissions are often less visible but more significant, making them critical to address in sustainability strategies and credible decarbonisation or net zero targets. In fact, Scope 3 emissions often account for upwards of 90% of an organisation's total greenhouse gas inventory. Regulators and other stakeholders increasingly expect transparency around Scope 3 emissions as they help build a full picture of climate-related risks and opportunities within the organisation. So whilst there are up to 15 up and downstream Scope 3 categories in total, not every one will apply to every organisation as they're highly dependent on what the organisation does and the sector in which it operates. Some of the key categories which are likely to be relevant to public sector organisations within Northern Ireland are summarised here. But for detailed guidance and information for each of the 15 categories, please refer to the supporting guidance provided by DAERA in addition to the documentation published by the GHG protocol, which covers detailed descriptions, guidance and calculation methodologies for all of the 15 categories. Categories 1 and 2 are typically quite key sources of emissions within Scope 3, and these result from the upstream, or sometimes called cradle-to-gate emissions, or embodied emissions from goods and services purchased by the organisation. So for Category 1, this looks at operational expenditures, or OPEX. So obviously these are the ongoing costs that an organisation incurs to run its daily operations, whilst Category 2 looks at capital expenditure, or CapEx, which are investments in longer-term assets that benefit the company for many years. So emissions result from all activities that go into producing physical products or into providing services. So for physical products, it's a little easier to visualize or conceptualize. So emissions result from everything from raw material extraction through to manufacture, post-processing and assembly up until it leaves the factory gates. So for category 1, that goes in that covers all things like raw materials, equipment, water supply, even things like software and other consumables. Whereas for category 2, you're looking at longer term assets such as machinery or buildings or vehicles. Category 15 might be another significant source of emissions within Scope 3, and these are classified, emissions from investments are classified as a downstream Scope 3 category because investment capital or financing is essentially a service that you're providing to another organisation. Investments may be included in your Scope 1 or 2 inventory depending on how you've defined your organisational boundary. So if you're using an equity-based approach, you would typically include your investment emissions in your Scope 1 and 2, but if you're using either of the other two methods, so operational or financial control, you'd typically be looking to exclude investment emissions from your Scope 1 and 2, but account for them here in this category, category 15 within Scope 3. A reporting company's Scope 3 emissions from investments are essentially the Scope 1 and 2 emissions of their investees allocated to your reporting organisation based on the proportional share of investment you have in the investee. And because investment portfolios are often dynamic and can change frequently throughout the year, you can identify investments by choosing a fixed point in time, such as typically that's the end date of the reporting year, or by using a representative average over the course of the period. Considerations when selecting which of the 15 categories to focus on, or in certain cases exclude from your inventory altogether, include expected magnitude of emissions, potential to influence reductions, stakeholder interest, regulatory exposure or urgency, and relevance to your operations and climate goals. Some may clearly not be relevant, whilst others might require more investigation. A lack of data may deprioritize a category, but shouldn't be the only reason to exclude it from an inventory, as secondary data sources or estimation methods can be used to screen emissions as per Scopes 1 and 2. Tools like the Greenhouse Gas Protocol's Scope 3 Evaluator can help with this screening exercise and prioritization, and the DAERA submission portal also includes a section to detail any gaps that remain in your submission. Again, prioritizing transparency where possible. As Scope 3 reporting is currently optional for public bodies, categories deemed non-relevant can of course be excluded with justification, but again, transparency is essential and it's a good idea to report all categories where possible. In fact, our general recommendation would be to approach Scope 3 accounting with the intention to aim for as close to 100% coverage where possible, then increasing data and methodology quality iteratively, rather than starting with a super accurate calculation methodology for a single category and adding categories over time. With this latter approach, you have a continually expanding inventory which is more challenging to manage and communicate. For Scope 3, the use of estimation methods is more prevalent and anticipated than with Scope 1 or 2, as accessing data is inherently more challenging when considering indirect emission sources across the wider value chain. A progression in accuracy across Scope 3 categories, as well as in Scope 1 and 2, can be expected from estimation using benchmark values, for example, to spend-based estimates from expenses data, which is a common data source in many of the Scope 3 categories, up to using primary quantity-based data. And this progression is expected to iterate through time and through successive reporting cycles. Quantity-based data at the higher end of the data quality hierarchy can be either average, so for example the average emissions per ton of steel, for example, that's purchased by an organization, which might be available from industry average life cycle analysis databases, or supplier-specific emissions factors provided by your organization's key suppliers, which account for the specific production processes used in your value chain. Often a combination of methods can be used within any Scope 3 category, and this is entirely acceptable and is a much more manageable approach for many organizations. So, for example, integrating supplier-specific quantity data and primary emissions factors unique to your suppliers. As the availability of these kinds of data sets increases, as Scope 3 reporting becomes more established and mature within value chains, and integrating those methods where it's available with less robust but more accessible calculation methods like the spend-based approach, which can generally be applied at an earlier stage for many organizations across the board. And the method used depends on data availability primarily, with the emphasis on taking effort to integrate more accurate methods that effort should be focused on key emission sources such as key purchase materials and services. So now moving on to an example calculation for one of these key Scope 3 sources. So firstly looking at Category 1 or purchase goods and services. So as just mentioned, a typical method of calculating emissions from Category 1 is using spend-based data. So that's what's demonstrated here. So we're looking at an organisation that spends £2,000 on staff uniforms over the course of the reporting period, over the course of the year. So I mentioned in the Scope 1 and 2 examples, and I kind of stressed the importance of aligning units of measure between activity data and the emissions factors that you select before calculating emissions by multiplication between those two. And that's true across the board when calculating emissions, aligning units of measure. So in a spend-based context, that's aligning currency. So you're looking at pounds spent typically multiplied by an emissions factor in the units of pounds, in the units of kilogram CO2e per pounds. But there's also some additional parameters to consider when sourcing spend-based emissions factors and calculating emissions using a spend-based method. So a good source and a reliable source of spend-based emissions factors that many organisations use within the UK is again published by the UK government. And they publish an annual spend-based emissions factor database every year, and that's aligned with SIC, so Standard Industrial Classification categories. So these are emissions factors per kind of industry sector. Again, so that's represented in emissions per pound spent on that service or good. However, there's a bit of a lag between when those emission factors are published, so it's typically a couple or 3 years behind the most recent reporting year. So the most recent database is for 2022 in the current year of 2025. So when calculating emissions in this example, we're looking at the reporting period being 2024. The organisation has spent £2,000 on uniforms within 2024. That £2,000 doesn't necessarily buy the same amount of product as it would do in the year in which we're sourcing the emissions factors for, which is 2022. So inflation has to be accounted for between the two to ensure that the spend is a representative quantity. You also need to check that VAT is included or excluded within your data, and again, ensure that aligns to wherever you're sourcing your spend-based emissions factors for. So the DAERA spend-based emissions factors are ex-VAT. So in this case, both the spend data and the spend-based emission factors are ex-VAT, so they're aligned. So once you've checked that the currency, inflation, and VAT has been aligned, it's just a case of multiplying spend by emissions factor in a similar way as you would do with activity data in Scopes 1 and 2. And yeah, obviously in this example, we're just looking at a single product that's purchased by an organization. So you can see how this can kind of scale up to become a fairly significant calculation exercise just for this single Scope 3 category. When you consider the large volume and variety of products and services that large organizations purchase over the course of a year, and selecting appropriate emissions factors for each kind of category or line of spend is the sort of time-consuming exercise here. So it's important to become kind of comfortable with this calculation and methodology, and yeah, again, to kind of ensure consistency and scalability when looking at your full organization's spend data. And obviously a similar method is used for other, or maybe used for other Scope 3 categories. So capital goods, category 2 is another example where spend-based calculation methodologies are used typically. But within category 1, you also want to be accounting for water supply that your organization is purchasing. And often this is a case or an area where activity data might be used because that quantity of water supplied to your organization is readily available in your utility bills, and that may be one of the first sort of purchase service in category goods or in category 1 where activity data is available for, at least initially. So when considering the spend-based method, you typically take the full expenses report from your finance department and start to assign spend factors to each line of spend or category of spend, considering if any aggregation of data is required to make processing the full data set manageable, whilst aiming to maintain as much granularity as possible. However, not all of the money that an organisation spends within the reporting period will likely be included in and will be included in the expenses report will be applicable to categories 1, purchase goods and services. So this table includes a non-exhaustive list of common purchase goods and services that are to be accounted for, alongside other spend that may be present in expenses data but is not to be classified under category 1. So for example, money spent on postage services for products you're purchasing in transporting them from your suppliers to your facilities. These are to be isolated and categorized under category 4, upstream transportation and distribution. Additionally, there are non-reportable organizational expenses that may be in the spend data but are not classed as a consumption item, as there's no clear emissions producing activity attached to them. So money spent on paying your staff, or moving money around internally, or charitable donations, for example. As Ollie mentioned in one of the earlier sessions, one of the key things to consider with greenhouse gas accounting in general is to avoid double counting within your own inventory. So the expenses may also include spend on utilities, so electricity and gas, for example. That will obviously already have been accounted for in your scopes 1 and 2, so we'd obviously be looking to isolate that money spent on utilities and not account for it again in your scope 3. Or as we discussed when looking at the data quality hierarchy, you may be using a combination of methods to estimate emissions from category 1. If, for example, you have supplier-based quantity data in addition to the spend data, but only for a small subset of products you're purchasing, you need to ensure we're essentially not calculating and accounting for these emissions twice from these two methodologies. So when considering the spend-based method, you typically take the full expenses report from your finance department and start to assign spend factors to each line or category of spend, considering if any aggregation of data is required to make processing your full data set manageable, whilst aiming to maintain as much granularity as possible. So obviously the previous example was very straightforward. It was only one line of spend. The full data set can often be rather large, so aggregation of data may be required. However, not all of the money that an organisation spends and is likely included in this expenses report will be applicable to category 1. So this table includes a quick summary of a non-exhaustive summary of some of the common purchase goods and services that are to be accounted for, alongside other spend that may be present in the data but is not to be classified under category 1. So a good example is money spent on postage services for your purchased products in transporting them from suppliers to your facilities. This is to be isolated and classified under category 4, upstream transportation and distribution. Additionally, there are non-reportable organizational expenses that may be in the data but are not classed as a consumption item, as there's no clear emissions producing activity attached to them. So money spent on paying your staff or moving money around internally, or donations to local charities, for example. As Ollie mentioned in one of his previous sessions, one of the key things to consider with greenhouse gas accounting in general is avoiding double counting within your own inventory. So the expenses may also include money spent on utilities, but that will obviously already have been accounted for in your scopes 1 and 2. So we'd be looking to isolate that expense and not double count it in your scope 3. Alternatively, if you're using a combination of calculation methods aside from spend data or the spend-based method, you'd obviously be looking to avoid accounting for these emissions twice when combining methodologies. So now moving on to category 3, fuel and energy related emissions. So obviously in scopes 1 and 2, we're reporting emissions from the generation and combustion of purchased fuels and electricity, but there are also other emissions generating activities within the life cycle of these fuels and electricity. So resulting from the extraction, production, and transportation before they reach your organization or before they enter the electricity grid. And these are referred to as well-to-tank emissions, and these need to be accounted for in category 3. Additionally, for purchased electricity, there's additional losses during the transmission along the kind of cable network that's within the grid, just because of kind of physical inefficiencies within carrying electricity through wires, and these are referred to as T and D losses. So again, we account for these additional emissions from the consumption of this electricity in category 3 here. So now looking at an example calculation which is using the same consumption data as we referred to in the example scopes 1 and 2 calculations, so the 22,000 litres of diesel and 50,000 kilowatt hours of electricity within 2024. So that's your activity data. It's the same, obviously the same consumption values as that is used in the scopes 1 and 2 calculations. But the different thing here in scope 3, category 3, is the emissions factors that are applied. So we're looking at the well-to-tank and T and D factors. Again, these are available in the DESNODES database, which is linked to the DAERA portal. So these emission factors are comparatively smaller than the combustion and generation factors we used in scopes 1 and 2. And as such, the resultant emissions are quite a bit lower. It's worth noticing that for diesel, we're just looking at well-to-tank. There's no kind of T&D conceptually for fuels that you're burning on site, but there is for electricity. And then for electricity, well-to-tank, there's two components. So there's the upstream well-to-tank emissions associated with the fuel, or with the electricity that's actually reaching your organization. So that's the first well-to-tank emissions factor value there. But there's also additional well-to-tank emissions from this additional electricity that's lost in transmission, so the well-to-tank T and D factor down the bottom, which again is even smaller. So next, moving on to an example calculation for category 5, which, as a reminder, is it accounts for the emissions generated in the disposal and treatment of waste that's produced during your organization's operations. So in this example, the organisation produces 2.5 tonnes of paper waste and 0.5 tonne of waste electronics annually, all of which is sent to incineration. And in this example, the organisation has engaged with their waste treatment provider, their supplier, and managed to understand that the scope 1 and 2 emissions that have been allocated to their organisation's waste only. Obviously, that's a smaller proportion typically of the waste treatment provider's total scope 1 and 2 emissions. You'd only be looking to account for the waste generated by your organisation, obviously. So yeah, this example is just demonstrating that where this primary data is available, it's of higher quality, it's more specific to the actual treatment methods that are used for the waste that's being sent to the waste treatment provider by the organisation. So it's a preferable source for category 5. But if that's not available, which it typically isn't readily available in the first instance, DESNODES publishes category 5 emissions factors, which are specific to material types, but also they vary between the different waste treatment methods. So there are emissions factors for paper incineration and waste electronics incineration. As with category 1, where we account for the water supply, in addition to other purchase goods, in category 5, we also account for the emissions from treatment of wastewater. Again, likely using activity data from a water bill. Next, an example calculation for category 6 or business travel. So of course, any organization is likely to have data from multiple modes of transport over the course of the year, but in this example, we're just looking at short-haul return flights for staff in Europe over the course of the year, so total of 25 flights. The emissions factors for business travel for public transport modes are typically represented in passenger kilometers, so we're accounting for the number of passengers on the plane in this example multiplied by the total distance traveled by the flights. for the year. So depending on what the data looks like, that can be estimated or calculated to varying degrees of accuracy. So in this example, we're just doing quite a crude estimation of average distance per flight, or using average distances per flight to estimate the total flight distance of 50,000 kilometers, including the return legs for each of those journeys, multiplied by the total number of staff to give a total passenger kilometer value, which again can be multiplied by the most appropriate emissions factor. So DESNES publishes emission factors for various transport modes and various classes of travel and distances of travel for flights in particular. So it's a case of selecting the most appropriate and representative emissions factor, again ensuring measurement units are aligned between activity data and EF. And then emissions can be calculated and represented in kilogram CO2 E or tons of CO2 E typically. When we were discussing category 3, we looked at well-to-tank emissions. Category 3 is only concerned with the well-to-tank from scope 1 and 2 sources, so purchased fuel and electricity that's captured within your organization's scope 1 and 2. There's also well-to-tank emissions associated with business travel and other fuel consumption within scope 3, and you typically account for those additional well-to-tank emissions within the same category as the emission source that the fuel is being used in. So for business travel, you've got this kind of primary combustion emissions that you're estimating on the left-hand side here, which is the 27 tons or 27.4 tons. You'd also look to multiply the activity data by well-to-tank factors for short-haul flights to estimate well-to-tank emissions within category 6. So that's happening on the right-hand side. So you're taking that same activity data total of 150,000 passenger kilometers and multiplying it by the well-to-tank emissions factor for a short-haul flight, which is a comparatively much smaller emissions intensity, to calculate this additional 3.4 tons of CO2e. It's also worth mentioning that you can report emissions from accommodation on kind of business travel expenses, and that's typically done on a spend-based approach, and that would sit within category 6 typically as well. Moving on to category 7, or employee commuting. So in this example, the organisation has conducted an annual staff commuting survey for a quarter of its staff, which the output of that survey is average daily distance estimates for each of the key transport modes used by its staff to get to work. So we need to, in a similar way to business travel, we need to calculate the total distance travelled by transport mode. So looking at petrol cars, the average daily distance by each of the staff is 20 kilometers. We're multiplying up by the number of respondents and the number of working days, and again accounting for return journeys to get this total of 300,000 kilometers. We then need to scale up and extrapolate the results from the survey to the total number of staff within the organization. So in this case, we're multiplying by 4, and then that process is repeated for all the other transport modes, and then we can assign appropriate emissions factors in the usual way. Again, we're accounting for combustion emissions, so that's from the larger of the two emissions factors, the 0.165 for petrol cars, and also well-to-tank emissions within category 7, so that's the 0.046 kilograms per kilometre. And then emissions are calculated by multiplying and addition between combustion and well-to-tank. It's also optional to include home working emissions, so accounting for the additional energy usage and electricity usage from staff inside their own homes during working hours. So DESNES publishes home working emissions factors now that can be used to estimate emissions from staff that work remotely, and that's done on a number of full-time equivalent hours basis. So you'd need to estimate that total for the staff that work remotely in order to multiply by the appropriate emissions factor, and then category 7 is a summation of all those various components. The final example calculation we'll run through is for category 13. So as a reminder, this is from emissions from the operation of assets that are owned by your organization but are leased out to other entities. So these emissions would not typically be in your scopes 1 and 2. In this example, we're looking at a building on the premises of your organization, which is leased out to another organization to operate a cafe, for example. So say you own a park within your organization, and on site there's a building which is used by a local business to run a cafe. You'd be accounting for the cafe's scope 1 and 2 emissions in your scope 3 category 13. So if the leasee, the cafe, cannot provide emissions data, but they can provide the activity data in the same way you would calculate your own scopes 1 and 2. You can use that to estimate emissions. But in this case, they have conducted their own scopes 1 and 2 inventory, so we can essentially lift those values of 25 and 42 tonnes respectively into category 13. In this case, all of the emissions from that cafe are allocated to your organization's category 13. That might not necessarily be the case. You might have to allocate the correct portion of their scope 1 and 2. If they have multiple sites, for example, and only one of them is one of your assets, you obviously need to allocate based on floor space or a more detailed breakdown of the leasee's scope 1 and 2 inventory, so you're accounting for only the correct emissions that are attributable to your assets. For a more detailed guidance on how this is done, you can refer to the Greenhouse Gas Protocol Scope 3 documentation, but it's fairly straightforward and self-explanatory. So it's probably coming across by now that Scope 3 reporting is kind of more resource and time intensive to estimate emissions from all the various sources than scopes 1 and 2, and as such organizations typically find it fairly challenging the first time they kind of carry out a scope 3 inventory, and it's challenging for a number of reasons. So obviously data availability and quality inherently, because you're kind of sourcing data from outside of your organization's direct operations inherently. You're communicating up and down your value chain and engaging with various members of your own business, but also members of your own organization, but also those in your suppliers and kind of downstream entities that you have relationships with as an organization, and you have kind of limited influence over those up or downstream actors. There's this kind of general balance that's required to be struck between accuracy and practicality and the time it takes to estimate emissions, particularly if this is your first time looking at scope 3, and it's worth just bearing in mind those same points we stressed in the scope 1 and 2 sections, that kind of nobody's expecting you to 100% accurately estimate all of your emissions accurately across the board. It's just not realistic, and it shouldn't be the priority. Obviously, all efforts should be focused on actual decarbonisation, but we're using kind of scope 3 reporting to maintain visibility and monitor reductions. So it's a good idea to kind of start this process and start this journey of iteratively improving data quality and calculation quality. And yeah, again, where possible, communicating and maintaining the visibility of all assumptions and references in the submission. However, it's not a case of just calculating scope 3 for the sake of it, and there are some tangible benefits which make understanding scope 3 emissions worth overcoming some of those challenges I just mentioned. So firstly, kind of deepened understanding of your value chain across your organization, and particularly within the organization or within the teams within your organizations conducting the scope 3 inventory. It helps identify greenhouse gas emissions hotspots on a kind of more holistic level. As I mentioned before, scope 3 is often a much more significant share of the overall impact of an organization. So typically a hotspot within scope 1 and 2 might actually be relatively insignificant compared to a hotspot within scope 3. So the true emissions reductions potentials and effort should be placed on scope 3 emission sources. So obviously understanding and quantifying those emissions in the first instance well, it's kind of the first step in that journey of true decarbonisation. Connected to that, it supports kind of credible net zero targets, which account for all three scopes. It can highlight kind of potential innovation and efficiencies within your organization's operations and its wider value chain. So, for example, looking at kind of improving supplier relationships or looking to build resilience across your supply chain and manage risks accordingly by kind of engaging with your supply chain around emissions reductions potentials. Finally, I'd just like to mention this concept of outside of scope emissions because they are referred to in the public body reporting guidance and the submission portal, and they're essentially kind of calculated in the back end for information purposes only. But yeah, outside of scope emissions are defined and result from the combustion of biogenic fuels, so things like biomass, biofuels, and biogas that's produced from recently living or biological sources, because obviously the greenhouse gases emitted when those fuels are combusted include a variety of greenhouse gases, as with all fuels, but the scope 1 impact of the carbon aspect of their emissions is essentially determined to be net zero, because during the life of the plant that's earlier in the supply chain of that fuel that's used to produce the fuel itself, that has taken in or sequestered the same amount of carbon that's released when it's combusted during photosynthesis earlier in the life cycle of that plant. So the overall net impact of the carbon component of its emissions is net zero. So it's not accounted for in kind of scope 1 emissions factors, but can be reported alongside as outside of scope emissions.
Welcome to the final session in today's greenhouse gas accounting training. This session will be on emissions data management. This session will focus on how you can take the learnings from the previous sessions on calculating your scopes 1, 2, and 3 emissions to set up an emissions data management process, as well with assembling your inventory and what that looks like. Then we'll look at data improvement planning, hotspot analysis, how you can use your inventory to create emissions projections and develop an action plan. And finally, we'll touch on emissions recalculation and rebaselining. Emissions data management is a continuous cycle of improvement. You start off by developing your emissions inventory. You then have a hotspot analysis to identify areas of greatest emissions production, and then you feed that into your data improvement planning so that you're driving improvement of accuracy from your largest emissions sources. Then it's a matter of how you can reduce your emissions, and you do that by identifying emissions reduction measures, projecting the scale of those measures, and creating an action plan to reduce your emissions. Then you need to report your emissions and potentially carry out assurance on your data, and then that cycle starts all over again. It is also important to have a strong foundation, a backdrop to this emissions management process in terms of a strong governance process, which includes the roles and responsibilities of the various people across your organization, as well as documentation, including a methodology document, and other quality management reports. Your emissions management process needs strong governance. Now, how you set out your governance is up to the reporting organization, but on screen are a few different considerations that should be included in that governance documentation. Firstly is a methodology. You need to write a methodology on how you've calculated your inventory, including all the data sources, the calculation methodology, the emission factors that you're using and the source, as well as any other conversion rates that are being used in your inventory, such as calorific value of gas to kilowatt hours or currency conversion rates. You also need to consider documenting the responsibilities, ensuring that there is a strong organizational structure for your greenhouse gas accounting. That includes the person who is responsible for providing data for each of the activities, as well as anybody that is responsible for internal audits and potentially external audits. With your carbon inventory, you do need to demonstrate some form of quality assurance. You need to review the data. You need to review the evidence that is being provided alongside the data to ensure that it is coming from a robust source. And you do need to demonstrate any actions that are taken to reduce mistakes or any emissions that could be present in your GHG accounting. You also need to describe your boundary setting criteria and how you're complying with that boundary setting criteria, listing out your organizations that are inside or potentially outside your boundary setting criteria and the detailing why, along with your Scope 3 emissions categories, what emissions are falling into certain categories and what categories are not relevant and why they're not relevant to your organization. Assembling your first carbon inventory is a daunting task. Typically, this is a task that could be done by only your in-house teams, but sometimes organizations don't have the skills or the knowledge in-house to do that. So you can bring in consultants to help you with your carbon inventory, to provide you with support and specific help on certain areas of your carbon inventory. It's also worth considering that there are softwares out there to help you with calculating your inventory. This could be as simple as using Excel for your first inventory, or you could look at more complex ESG reporting platforms. This balance of in-house teams, consultants, and software, it will change over time. You may wish to start off with consultants to help you calculate your first inventory, take that inventory in-house, and then over time, as your inventory becomes more complex, you may wish to use a more complex software platform. I typically wouldn't recommend going for a software platform as your first inventory, as it is a complex process, and it is worth taking the time to understand your organization and your emissions producing activities first before looking into a more complex software-based solution. If you are an organization which does have a well-established emissions accounting emissions inventory, you could consider advancing it through the use of a software. Now on screen I've got a selection of softwares there. The ones at the bottom are the ones which are are most mentioned in a survey done by the Scope 3 peer group. It is worth noting that the Scope 3 peer group does have valuable resources, so if you are looking to advance your Scope 3 inventory, do have a look at their resources that are freely available. When looking at a software, it is worth considering the maturity of your own organization. Are you ready to move to a more complex process that a software provides? Softwares do provide efficiencies, but typically, as you make use of the efficiencies that a software provides, you will also increase the complexity of your inventory. So this typically doesn't reduce the resource requirements from your organization to calculate your greenhouse gas inventory. It will, though, help the quality of your inventory over time. Calculating your inventory is not just for reporting purposes. It is to incentivize action. The first step to take action to reduce your emissions is to carry out a hotspot analysis. A hotspot analysis is the process of diving into detail of the key emissions producing activities across your organization. So, starting with a bird's eye view of your Scope 1 and 2 emissions. For example, this pie chart on the right, you can clearly see that electricity is the largest source of emissions. So the hotspot analysis would be for me to dive into detail about which facilities are producing the most emissions from electricity and what processes are happening at each of those facilities to drive that emissions production. Now, I might be able to understand the exact cause of the emissions production. It could be a particular process which is particularly energy intensive, or the data that I'm being provided with might not give me the detail that I need. So a hotspot analysis can have two outcomes. Firstly, simply a list of actions that can be taken to reduce your emissions, which could be used in an emissions projection, which I'll touch on in a moment. Also, hotspot analysis could incentivize data improvement planning. So simply you don't know enough yet to take action, so you need to find out in more detail what is driving your emissions. But now we'll look at data improvement planning. Data improvement planning is the process of improving your inventory to get more granular and more specific information associated with the highest emissions producing activities within your organization. This may involve things such as supplier-specific emissions reports, swapping that for a less specific spend-based method, or looking to collect primary data instead of an estimation. You should prioritize the areas where you can have a high impact, or areas with a significant amount of emissions, so that these activities has the greatest impact. Let's take an example here of how to improve your data quality and how to use a hotspot analysis to do so. Looking here at this chart from Ricardo's own corporate carbon inventory, we see that PP is the business unit which produces the largest amount of emissions. So that is an area of emissions that I should focus on. Then, within that, I see that category 1, that blue section there, is the largest emissions producing category. That is purchased goods and services. Then, within that, we see that if I dive deeper into that data, I know that the greatest contributor to that blue part of the emissions bar there is spend with engine components. And currently we're using the DAERA emissions factor associated with other basic metals and castings, and using that multiplied by the cost of these goods to calculate the emissions of these engine components. Now this is a perfectly normal way of calculating emissions, but it doesn't give me the detail that I need to have a discussion with the design team on the materials that are being used, or to have a discussion with the supplier on what they can do to reduce their emissions. So I need to improve the granularity of this calculation so that when I do make changes, or to identify the changes that I could make, we can have a productive conversation. Now, this would look, to improve the quality of this calculation, I would need to use primary data from the components within the engine. So this is an example of what that would look like. I would take a typical engine that we're purchasing, and I would look at the various components and the various materials that are being used. I would then use specific emission factors associated with the mass of each of the various components, and then I would look at the number of which we're purchasing as to calculate the total amount of emissions associated with these engines. Now this would allow me to have a more detailed conversation with the supplier, because I could look at the components within the engine that produce the most emissions, and then I can take specific actions to reduce the emissions associated with those products. The benefit of doing this is that when I do make a change, I will be able to see those changes in my carbon inventory. And so those actions associated with my decarbonization plan will be reflected in the inventory in future years. Because if I continue to use the spend-based method, I would not see that, because the emission factors that I'm using would be associated with the general basic metals and castings industry, not the specific actions that I'm taking to reduce emissions across these particular emission sources. So another way that a hotspot analysis is useful for your organization is that it allows you to identify key areas of emissions reduction. When considering emissions reduction measures that are available to you, it's important to consider that you have two options with that. You can change the emissions factor associated with a measure simply by changing potentially the fuel source that's being used, or you could reduce the activity that is being carried out. So an example of this could be switching your fleet of vehicles to EVs. You may wish that because of the reduced emissions that are produced from electric vehicles compared with internal combustion engines. That would be an example of reducing the emissions factor associated with a particular activity. You may also want to implement a travel policy which prevents employees from driving excessive distances. That would be an example of how you will reduce the amount of an activity that is being produced. So when considering your decarbonisation measures, you have these two options to alter to identify a reduction. When you have a collection of these emissions reduction measures, you can use these to develop an emissions projection. An emissions projection is a useful tool to assemble all of these measures to understand how your emissions inventory is likely to change over time. This can come in a number of different forms, and in different levels of complexity, but some simple examples are on screen there. If you look at the graph on the right, you can see that it starts off with the baseline inventory, and a series of emissions reduction measures are layered on top or aside the baseline to see what the residual emissions are once all these measures have happened. So if you were to take these measures and spread them out over time, it would look a little bit like the graph on the left, which shows the emissions of an organization over time. Decarbonisation planning and emissions projection has a structure that looks like this. So starting on the left, the start is your emissions inventory. So by using your emissions inventory, that gives you the current day emissions producing activities, and then it is a matter of combining a series of assumptions to determine what your emissions will be like in the future. Now, obviously, this will involve a series of reduction measures. These are actions which you can take to reduce your emissions. Now, these reduction measures are typically organized across 3 different scenarios, and it's up to you to determine how you best wish to organize these scenarios. Typically, you would have business as usual, which is if you're these are measures which would be taken regardless of any additional implementation. So these could be decarbonisation actions which have already been completed or finances have already been committed. You then have best practice, which is a series of reduction measures which are considered to be best practice across your particular sector. So that may be swapping to EVs when your fleet is up for renewal. Then the final scenario that you may wish to consider is the lowest possible emissions. So this is when you start to primarily look at the emissions reduction of the measure rather than any other considerations such as cost or technological availability to see what the greatest possible emissions reduction could be. You then also want to layer into these scenarios are business changes. So your business will change over time and your emissions will never stay the same. So you need to look at what are the trends that your business is experiencing and how that would affect your emissions inventory too. A typical thing to consider is growth. So most organizations want to grow, and as such, their emissions will also grow. So you will need to model this in your emissions projection to ensure that the emission reductions that you're planning overcome the growth that your business is likely to experience. You then take all these various measures and these business changes in these different scenarios and include those into an emissions model. That typically could be in an Excel model or a software that you could purchase. That then is summarized into an emissions projection, which typically looks at your emissions trending over time from 2030 to 2050, with those different scenarios modeled on those various graphs.
Target setting. It is important that your organization sets decarbonisation targets to ensure that you are taking action to reduce emissions and can monitor your progress against your baseline year. There are 3 different types of targets that you can set, and it's often best if you set a combination of targets across a broad-ranging period of time so that you have a number of different goals that you can hit and report against periodically. The first is an absolute target, and this is when you reduce emissions by a specific amount or a percentage related to the baseline year over a certain period of time. An example of this is on the left with the 48% by 2030 reduction from Northern Ireland's Climate Change Act. The second is an intensity target. This is when you reduce emissions compared to a certain activity. So for example, if you're a manufacturer, this could be the emissions from a product manufactured. or a transport provider may have an emissions intensity target related to the emissions per ton mile of delivered product. So by reducing emissions against a certain key activity of your organization, it is important that you select the activity or the denominator of this intensity target that's very relevant to the emissions that you're keeping in the numerator to ensure that the intensity target is well founded and well aligned. The final one is a qualitative target. This is when you reduce the number of emissions producing events or similar, so not necessarily related to ton CO2 in the target, but an emissions producing activity nonetheless. An example of this would be 80% of electricity consumption from renewable sources from the Climate Change Act. Another example is when you engage with your suppliers. So you say 80% of our suppliers are going to have decarbonisation targets and be SBTi aligned. So that means that you're not tracking the emissions from those suppliers, but you're tracking their progress to reducing emissions as well.
So as we've mentioned previously, the emissions management process is cyclical. You will continue to calculate your emissions year on year, and your business will not stay the same, and neither will your methodology. So it's important to consider a recalculation of your baseline if any of these changes are to happen in the future. So typically, an organization would set a threshold of 5% for any as the threshold for any material change to an inventory. Material change may come from structural changes to your organization, such as mergers, acquisitions, or divestments, or if you were to materially change your strategy, your business strategy, or radically change your business in any number of ways which would have an effect on your emissions by more than 5%. Your methodology can also constitute a rebaselining. So if, for example, you're carrying out data improvement actions, such as we'd explained earlier, that amounted to a greater than 5% difference in your emissions, you would need to rebaseline. So you can take steps to adjust your baseline to represent the current year of reporting so that your results are consistent and changes in your emissions inventory are not due to your business changing or your methodology changing, but down to the actions that you're taking to reduce emissions. On screen, we have a couple of examples of changes the business may go through, and we'll work out whether we think it should be a rebaselining or not. Firstly, a change which involves new facilities being added to your organization which weren't present in your baseline year. This would constitute a rebaselining if the impact of these new facilities on your organizational inventory is greater than your threshold value. Secondly, outsourcing/insourcing of activities that may have been reported under Scope 2 or Scope 3. So for example, you carried out an operation, but you decided that you would outsource it to a third party, shifting the emissions from that activity from Scopes 1 and 2, because it was your operations previously, to Scopes 3, because it's now a service that you procure from somebody else. That would not constitute a recalculation, merely a recategorization of the scope of emissions where it is placed in your inventory. And finally, organic growth or decline. Organic growth or decline does not constitute recalculation because your business is simply growing and changing. You're just doing more of what you've already done. This is not a reason to recalculate your baseline, and is often one of the challenges that is associated with decarbonisation because businesses want to grow, but they also need to reduce their emissions at the same time. Your organization may also want to look at third-party verification or assurance to ensure that you're presenting a robust emissions inventory. Now, we're not going to go through the entire process of verification, but there are a couple of things to consider before you embark on this. Typically, much like financial assurance, it comes in limited and reasonable in terms of the level of assurance which a third party may provide. It's important to understand whether you're ready for assurance. Assurance requires a detailed carbon inventory, as well as clear management processes and training for all staff involved. And it's also worth considering that you do not need to assure all of your scopes 1, 2, and 3 inventory at once. You may wish to start off with scopes 1 and 2 because that is often an area where you have the best data, and then you may wish to start on scope 3 after a couple of years or so. You can also do this with the gap between limited and reasonable. You could start with limited for your scopes 1 and 2, and then you move to reasonable for your scopes 1 and 2, and at the same time as doing that, you could start to look at limited for scope 3. This is a process which you can build into your data improvement planning. So that concludes today's greenhouse gas carbon accounting training. Thank you very much for watching, and if you have any questions, do reach out to DAERA or to Ricardo for more support.